Copart has been one of the best performing stocks over the last few decades, returning a 21% CAGR since its IPO in 1994. And I would say there's still plenty of room to grow.
The stock is consistently trading at a premium, but it's currently down over 20% from its all-time highs, which could maybe give us a good opportunity to take a closer look at this thing.
I guess the market is just uncertain about some short-term headwinds and especially about how AVs will impact Copart in the long run. But I believe those fears are mostly overblown, and I think you will see just how wide Copart's moat is in today's episode.
Today, we will talk about a company that, at first glance, has one of the most boring and unattractive business models out there. I think it's safe to say that, but we all know that old investing adage that the most boring industries and businesses can often come with the best returns, or at least that's a lesson I learned from Peter Lynch. And it's no different today. The company we're covering in this episode is actually one of the best performing stocks of the last 30 years, despite being pretty boring. I'm talking about Copart, a junkyard and online auto auctioneer that has compounded at roughly 21% per year since its IPO in 1994. Meaning that if you'd invested $1,000 at Copart's IPO, you'd have more than $300,000 today. And unfortunately, we were not lucky enough to have done that at the time. But I would say that Copart's business has really only become stronger in the time since. So maybe there's a decent chance that the forward returns won't look so bad either. Or at least that's what I'm hoping you'll tell us with our pitch today. Daniel.
Well, another 300 or 400x might not be on the menu here, but as you said, Copart's business is just so much stronger now than at most points, if not all points, in the last 30 years. And we're talking about a highly profitable company in a duopoly that has gained significant market share in the last decade. And that is really one of the strongest moats I think I have yet covered here on the show.
Yeah, that sounds good. I mean, before we get into the details of the business, though, how about you give us some background on the company's history? I know that Copart is a company where culture matters a great deal, and the culture was fostered by a pretty unique founder.
Well, Copart's story began in 1982 when Willis Johnson, who is the founder of the business, opened a single small salvage yard in California. And Johnson is not your typical CEO. He has no formal education, and his business was certainly not optimized by Wall Street standards, as we will see today, but he was equipped with a ton of life lessons. He was a veteran who served in Vietnam, and our colleague Clay has actually done a phenomenal episode on the book that he wrote and how it shaped Johnson serving in Vietnam and also his thinking. So it's not too surprising that Copart is one of those companies with a pretty unique and a very special culture. And Copart was and still is a family-driven and also tightly run business. And if you want to summarize just how Johnson thought of spending money, you can do that with a single simple quote. And I think that quote could just as easily come from Buffett as well. He said, "Watch your pennies and the dollars will take care of themselves."
It reminds me of the old saying, protect the downside and the upside will take care of itself. It's sort of the ethos behind that. Of course, there's so much more to be successful in investing. And the same is true for running a successful business. But I do think it shows where the priorities are.
Johnson generally just strikes me as a person who fits Buffett's argument that good business owners would also be good investors. And they just have a lot of the same traits. I wouldn't be surprised if Johnson, for example, had also been a great investor if he had tried his luck in the stock market instead of running a junkyard. So there are many similarities between how Buffett ran Berkshire and also how Johnson ran Copart, especially in terms of trust, discipline, and especially gut feeling. I think everyone who listened to our Berkshire episode just a couple of weeks ago knows that Buffett trusted his gut a lot when it came to deciding who to work with. And from everything I've heard, Johnson did that as well. And at times, that hindered Copart's short-term growth, but I would argue it turned the business into the compounder that it is today. In the 1980s and 90s, Copart pretty much expanded, and the one small yard in California grew to 4 yards. And honestly, from what you can read in the book Junk to Gold, which is also the book that Clay covered in his episode, Johnson was the last person to think that Copart would ever be a publicly traded company. And it built so much momentum over time that by 1994, that idea no longer seemed outlandish. So Copart did IPO on the NASDAQ, and that capital that the IPO brought in was pretty much a Kickstarter for more investments into the business. One of those investments was a company called North Texas Salvage Pool, which was the largest salvage seller in the country. And just a year later, they acquired a company called NER Auction Group, which immediately doubled Copart's yard and firmly established them as one of the largest players in the country.
I think it's probably too much to call Copart a serial acquirer in the way that we think of Berkshire or Constellation Software being, these kind of famous serial acquirers. But I mean, it does sound like strategic acquisitions have been an important part of Copart's business strategy since the beginning. And another thing that I think really set apart Copart was its push into this online marketplace that it's built. And for context, my understanding is that Copart launched this website all the way back in 1996. So they're actually pretty early adopters of the internet, it seems like.
Yeah, Copart's roll-up strategy was definitely a key part of their successful growth, but the willingness to embrace the internet at the time when most companies, especially junkyards, would have just laughed at the strategy might have been an even bigger step for them. As part of its push into the online business, Copart launched CAS, which is its centralized auction system. And only a little later, Copart introduced internet bidding. And today, that doesn't sound like a huge innovation, but back then, it was a pretty new concept. Even eBay only existed for about 3 years back then. And selling Pokemon cards online, I would say, is a bit easier and maybe straightforward than selling total cars. So generally, I think you can say that the better a decision is, the more obvious it looks in hindsight. But this was not a no-brainer bet at the time when Johnson did it. It was a bet, though, that paid off tremendously, and until then, auctions were exclusively done in person. So as you can imagine, that's a lot more capital intensive, and the buyer base is significantly smaller than when you do it online. So by eliminating the need for physical options, Copart just dramatically increased liquidity and broadened both its national and also the international buyer base. And with the US market maturing, by now it's the international buyer base that has become a lot more important. And it's probably also a big part of the thesis today. And it generally just strengthened Copart's flywheel. A seller was just far more likely to get higher prices for their vehicles if thousands of bidders from around the world could participate, and not just the people who could show up at a local yard somewhere in California at the right time. So the online auction meant more buyers, which meant better prices. Better prices attract more sellers, and more sellers created more and better inventory to keep buyers engaged.
For anyone watching, I think my eyes kind of lit up when Daniel said flywheel, because that is one of our favorite things to talk about on this show, and companies that have flywheels. And, I don't think we've really found a company with a compelling flywheel for a couple episodes now. So when you say it with Copart, I'm definitely intrigued. So how about we take a clear look at really the business structure and what exactly Copart does and what their flywheel really is.
So the easiest way to think about what Copart is a marketplace for total car, basically. In one sentence, that's what Copart is doing. Every year, millions of vehicles reach the end of their useful life, and that could happen because of accidents, natural disasters, or simply just age. And Copart sits pretty much in the middle of that process. So it's connecting the sellers of those vehicles, most often insurance companies, with a global base of buyers who can still extract value for them. So Copart, for the most part, is not taking ownership of these vehicles. It's just the marketplace, and it's taking care of storing the cars on the yards that it owns. And I guess going through an example might be the easiest way to explain exactly what Copart does in reality. So imagine you're involved in a car accident, which we hope will never happen, but you never know. Maybe someone else is driving into your car. So depending on the accident, your car can either be repaired or totaled. And it's really up to your insurance company what will happen. Obviously, the insurance company would lose money either way, but as every good investor or businessman would, it tries to limit its losses. So let's assume a repair would cost, let's say, $5,000. The insurance company would then determine how much money they could receive if they would just sell the damaged car. If it's more than $5,000, they will just go ahead and sell it. And that's basically where Copart would step in. Copart would handle the towing, park it in one of their junkyards, take photos, and then eventually list it in an online auction.
So on the seller side, customers are insurance companies, it sounds like. But then I guess my question is, who are the buyers of these totaled cars? I mean, I assume they would mostly be going to dismantlers. Is that the right way to think about it?
Yes, most buyers are dismantling companies that take the car apart and then just sell the parts that are still intact or can be used. But used car dealerships, exporters, and even individuals overseas can be buyers as well. I mean, a total car does not necessarily mean that it's completely undrivable. In countries like the US or in Germany, where regulations for cars are quite strict and just cars are equipped with way more advanced technology, even relatively minor bumps can cause significant damage, and a car, which is sensitive because it has a lot of sensors, might get totaled. But again, a total car just means it was cheaper for the insurance company to sell it instead of repair it. So there are a lot of cases where customers, especially overseas, let's say in the Middle East, can still drive these cars without having to do any expensive repairs.
Whenever I think about a total car, I just have these pictures in my head of like a completely wrecked car smashed from back to front. But I've come across a number of posts on Reddit when I was looking into the Waymo versus Tesla debate for my Uber episode that I pitched a few months ago. And many of those totaled cars really did not seem to have been damaged that badly. And I guess that just shows how much more quickly modern cars can get totaled. So theoretically, Copart's website is open to all kinds of buyers, it sounds like. And meaning if we wanted to, we could also go on the website and buy a car. And so it sounds like you don't need to be a licensed car dealership or dismantler to bid on the cars. It's really kind of an open market.
Yeah, that's right. I mean, I would be the last person to do it because I'm the last person on this planet capable of taking a car apart. But technically, we could also go on Copart and bid. You do need a membership, though, to be able to bid on those cars on Copart's website. And I think the basic one costs about $100 a year and the premium one costs $250 a year, with the difference mainly being limited buying power for the basic membership. And limited buying power means that if you have deposited $2,000 into your Copart account, which is the minimum deposit that you have to put in, then you are only allowed to bet 15 times that amount under the standard membership, and then up to, I think it's 30 times that amount under the premium membership. On the buyer side, you can clearly see the advantage of Copart going online so early because about 40% of their buyers are international customers, which is quite a lot for a company that's not much more than an American junkyard company. And that global buyer base brings just a ton of volume. On any given day, Copart has about 250,000 vehicles available. And in the span of a full year, it sells more than 3 million cars.
So to speak about membership fees and the advantages of going online first, how exactly does Copart make money? And then who are they really competing with?
The membership fees are one way, but it's a small portion of the overall revenue. Despite having over 250,000 paying members worldwide, a good proxy for the membership is Copart's deferred revenue, and that usually sits between $25 and $30 million. So generally, Copart charges quite a bunch of fees, and they are more material than the membership fees. The first, and probably also the most important one, is the transaction or auction fee. This fee is generally charged to both the seller and the buyer of the vehicle, but the majority, I think it's about 80% of the total fees, are generated from the buyer side, which is not too surprising since it's the buy side that is pretty diversified. With the seller side, on the other hand, it's pretty dominated by big insurance companies. So obviously, the insurance companies have more negotiating leverage. If you squeeze too much out of a big customer on the seller side, well, then they might leave and take a lot of volume with them. Generally, the fees typically scale based on the sale price, which has served as a tailwind in recent years. Not only are cars becoming more expensive, but as we mentioned earlier, they're also being totaled more frequently due to the extensive sensors and all the technology in those cars. So on average, more cars are getting totaled, and the prices of those totaled cars are significantly higher now than they were 10 or 20 years ago. Used car prices were also extremely high, especially in the years of 2021 and 2022, which is why you see a margin peak in about that time. But margins are reaccelerating now, though, so it doesn't look like the trend of them declining is continuing. And really a key metric is the total loss ratio. That's a metric you should keep an eye on if you look at Copart, because it measures the percentage of cars involved in an accident that were then totaled. And according to Copart, this metric has risen consistently since Copart was founded.
And the thing that I'm thinking about as I'm trying to understand the business here is really approximately how large these fees are that Copart earns, and then like how sustainable is that take rate that they generate when they do these auctions?
Yeah, so Copart does not publish the seller fees, but it does publish the fee structure on the buyer side. And without going too much into the details, buyer fees typically land in a range of 7 to 13%, and it really mostly depends on whether the car is total or a used one, and then the volume a buyer purchases, and also the payment method that he uses. Beyond the transaction fee, you have fees for listing and processing vehicles, and for towing, storage, and all of that stuff, which just basically happens behind the scenes. And on the seller side, we only know that Copart uses a fixed fee per unit or percentage incentive program, where fees are predetermined as percentages of the sale price of the vehicle. And that's kind of a win-win value proposition because Copart has an incentive to sell the car for as much money as possible because that increases the fee it earns. And that obviously also benefits the insurance company because they want the car to be sold for as high of a price so they don't make as much of a loss when a car is totaled.
You mentioned used cars because Copart also sells cars that aren't totaled, and I think they come from rental companies or car dealerships, and about 80% of the volume comes from these insurance businesses, which means the cars are coming to them totaled. But from what I've seen, about another 20% are these used cars maybe coming from other sources. And so I guess those would be the cars that you and I would probably be more inclined to buy, since I'm just as incapable of repairing a car as probably you are, and maybe worse.
Worse is probably very difficult to do, but maybe we are both not talented. So yeah, it's absolutely the case. All fees related to these total costs with insurers as sellers are reported as service revenue in Copart's financials. They make up about 80 to 85% of total revenues in a given year. The remaining revenue comes through these vehicle sales that you're just talking about, where Copart basically takes ownership of the cars before they sell them. And that's a business you're referring to with the used cars. And the sellers here are not insurance companies, but as you mentioned, rental companies, used car dealerships, or even financial companies. And in those cases, Copart acquires the cars first, and then they sell them through their own website and the bidding process. And this just makes a lot of sense when used car prices are high, as we said in, for example, 21 and 22, because when that's the case, insurance volumes for Copart tend to go down because it's more profitable for insurers to repair cars instead of paying the pre-accident price to the owners. And that's obviously bad for Copart because it means that they just miss out on a whole lot of volume. And as I said, this kind of is what happened in 2021 and 2022 when used car prices basically skyrocketed. And when you look at the Mannheim used car index, which we currently have on the screen, you can see the huge spike in prices in that period. And when you layer that over Copart's sales, you can see that those were the years when vehicle sales or the revenue made by vehicle sales became way more important in the overall revenue breakdown. And the second reason for the vehicle sales business is the international markets, because while the service model is pretty popular and it's well established in the US, it still remains relatively unknown in most international markets. So whenever Copart basically uses this approach to demonstrate to companies outside in those international markets that it's value accretive to insurers. So basically showing them, look, this model works, our platform delivers much higher liquidity, which means you can achieve higher prices. Then once the model is proven, those relationships often migrate to the more capital-light service-based model. So just last quarter, for example, Copart's average selling price rose by over 5%, and that's faster growth than the average used vehicle, according to the Mannheim index, but it's also way faster growth than the growth of competitors in the industry.
That point there on Copart's margins expanding, actually, being due to international markets, I mean, that really is kind of interesting to me. And as you have international markets moving from these lower margin purchase models to the higher margin service model, I would imagine that it explains kind of what's happening here. And last year, fee-based revenue grew 10%, while vehicle sales actually declined slightly, largely due to Germany and Spain transitioning away from this purchase model and opting into Copart's flagship service model. So basically you have the business moving into, parts of its revenues moving into a higher quality business line that's making the overall business more profitable. And one of the attractive things about Copart is its strong market position and really the barriers to entry, how hard it is for competitors to come in and compete away the economic profits that they accrue. And so on a small scale, operating a salvage yard and selling cars really does not seem like a complicated business. You're probably thinking, how the heck does a company like this have any kind of enduring moat? And it is subtle, but I would say if you want to operate these junkyards at scale, it is sort of a different story. And maybe just to make an example, you're probably not annoyed by a Chick-fil-A opening next to your house. I am actually delighted when that kind of thing has happened. Or maybe when a KFC opens up nearby. That is probably not really going to bother you either, with the point being when new restaurants and stuff come to town, that can actually make your life better. But when you hear that a huge junkyard is going to be built next to your house, you probably have very different feelings, especially if that's going to hurt your property values and make it harder for you to sell your house down the road. And that's why getting these permits to build junkyards is just anything but easy, because you have this NIMBYism, the not in my backyard acronym, where everybody likes the idea of, oh yeah, I want to have a place to, drop my junk. I want to, have a place to take these totaled cars, but no one wants to actually live near that place. And so that makes it, a very limited number of lots that can be built in that way. And so that is sort of this natural barrier to competition entering the space, especially for, large scale competitors to come into the market the way Copart has. And that's because, besides Copart, there's only one player of any kind of similar size. And that's a company called IAA, which stands for Insurance Auto Actions. And this is really a duopoly. The two of them control about 80% of the market, with the rest being much, much smaller operators. And even within that duopoly, Copart is kind of the dominant player. They have been steadily outperforming IAA for years now and taking market share on the margins away from them. And I think a big part of that, as I've come to understand through you, Daniel, is really the differences in culture. IAA tends to follow this very classic Wall Street playbook where they're chasing fast growth and there's kind of a short-termism to the mindset, where Copart, by contrast, has really proven to be much more focused on supporting the long-term durability of the business.
A great example of that is that IAA actually rents all of its yards, which is a lot easier and allows, of course, for faster expansion, but Copart has always bought the land it operates on, and today that's more than 250 yards globally. And that investment alone has paid off tremendously. Most of the land was bought decades ago, and back then it was on the outskirts of the city, so they bought huge spaces at relatively low prices. And today many of those sites are in or at least near densely populated areas. And
even Einstein had blind spots. That's why modern science is built on the idea of peer review. Investing may be more art than science, but that doesn't make peer feedback any less valuable. The tricky thing is finding qualified people who are interested and willing to help vet your investment ideas. That's why we built the Intrinsic Value community. It's a place to connect, share ideas, learn, and get feedback. Nobody ever wishes they'd spent more time buried in spreadsheets, but connecting and building relationships with others who may be smarter on a topic than you, but who are also schooled in value investing, that's valuable. We make spots in this exclusive community available in cohorts every few months, and last time around, our 30 available spots filled up pretty quickly. If you're interested in our next cohort, which will be even smaller, you can join the waitlist at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community. Look, every hunter, camper, and backpacker needs one of these. That is a Harvest Right freeze dryer, which lets you preserve your own meals and snacks. It's perfect for your next backcountry adventure or hunting trip. You can fuel your adventure with freeze-dried strawberries, bananas, pineapples, and even full home-cooked meals. No more relying on expensive store-bought, preservative-packed food. You can also preserve wild game with your Harvest Right freeze dryer. That's right, take control of your harvest by freeze drying venison, elk, or fish, so you'll always have high quality protein ready to go. And your pets will love the freeze dried treats too, just like my dog Riley. Freeze dried meals are lightweight and long lasting, staying fresh for up to 25 years, yet they taste just as good as the day you made them. Whether you're hunting, camping, or prepping for emergencies, a Harvest Right freeze dryer keeps you ready for anything. It's like having extra cash in your portfolio to take advantage of downturns in the markets. That's how I think about it, at least. Learn more by visiting harvestright.com/investors. That's harvestright.com/investors. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout.
as you said, no one wants a salvage yard in their backyard, so permits for new sites, they're just incredibly hard to get, and this makes Copart's network of yards and not just an operational advantage, but I would say it's basically a near impossible barrier to entry. And compared to IAA, they never face rent increases or even just the possibility of losing the right to operate a yard. And one interesting side note here is for anyone who wants to look into the business or the financials of Copart or even IAA themselves, is that by owning the land, Copart appears much more profitable at first glance because while owning the land does help with profitability in general, it does not help to the extent that margins would suggest. Copart's margins are significantly higher than the ones of IAA, and that's because the costs for its yards show up as capital expenditures rather than lease expenses. And that way they basically circumvent the entire income statement and therefore inflate margins at first glance.
It is kind of confusing when you first look at Copart's numbers, because I remember, pulling it up on FinChat and I'm looking at it and thinking, okay, how is this company so profitable for what is, after all, a junkyard business? Because, really it almost looks like, from a margin profile, it almost looks like a software company. You got gross margins at 45%, operating margins at 36%. For context, I believe that's higher than Alphabet. And so it's just clear that Copart operates with this really highly efficient model, of course. And there is an online component to it that is, software based. And then also you have these accounting discrepancies that it's not cheating, but it's just something that as an informed investor, you have to kind of be aware of and look out for that kind of thing of, it's not exactly an apples to apples comparison because there are these subtleties to how Copart's margins are calculated. So even, like I said, if I compare the operating margins of Copart to Alphabet, the business models are so different that the comparison is borderline meaningless. So the point being, even if these numbers are slightly inflated due to the way Copart capitalizes its land costs, that's the sort of accounting jargon we were talking about, the free cash flow margins, which basically would account for that in them, are still a very impressive 26%. So, this is a company that no matter how you cut it, is still very profitable and very capable of generating cash. And I think it's a very unique and robust business model that has been very durable for decades now, as we've seen. It is not a cyclical business in the way that you might think. And, if you just pull up the balance sheet for Copart and compare it with the information I can find on IAA, which we've got on screen right now, it looks like Copart is really kind of the more conservative company here too. You're taking on less financial risk and also getting a business with, higher quality operations. They've got almost $5 billion in cash and cash equivalents with very, very minimal long-term debt. I think in part because they own a lot of the land itself. So there's not really much need for them to have debt. And so the numbers I have on IAA are not necessarily up to date, but as of at least a couple of years ago, IAA had a net debt of $3 billion, which is just a very, very different position to be in. And when we were chatting before our call, you mentioned that IAA introduced these online auctions actually during the financial crisis in 2009, whereas Copart started in 1996. So that's a 13-year first mover advantage that has been, compounding in Copart's favor of building customer stickiness, more iterations of testing, what works and what doesn't work. And really, it wasn't until the pandemic hit that IAA pivoted to really trying to entirely do online auctions. And considering how important those online auctions have been for Copart and specifically their international customer base, it seems like Copart must be years ahead of IAA, I would think.
They definitely are. And when I was digging into Copart, I was more than surprised seeing that IAA is so far behind because it's making sense that in the late 90s, you basically do not yet see how the internet could change a junkyard business. But at some point, you got to realize that your competitor is doing way better than you, and you should copy what they are doing. And it just took IAA a while. I mean, Copart launched its first fully online auction in the early 2000s, and it's patented this virtual bidding system, which has improved ever since. And I think it's currently in the third generation. And fortunately for IAA, insurers have no incentive to turn this market into a monopoly because if Copart controlled the entire market, insurers would lose negotiating power and risk being squeezed on the fees by Copart. So even though Copart has gained share from IAA in recent years, and Geico, for instance, is one of those insurers which switched much of its volume to Copart, there's a natural ceiling on just how dominant it can become because, as I said, there's no incentive for insurers to make this market a monopoly.
Well, if I can just quickly ask you, do you know why, or how would you explain how Copart has been able to continue to gain market share?
I think there are many smaller reasons for why, and in some way or the other, basically most come back to trust. Since Copart owns the land it operates on, it runs its business with real operational discipline, insurers know they can always rely on Copart, and more importantly, they know they're likely to get better results too. And this platform's liquidity advantage means more bidders, which translates into, as I said before, higher selling prices for the cars. And at the end of the day, businesses want to make money and insurers want to make money as well. And Copart is just the better option for them to choose. And a great example of how this trust is influencing the decision to go with Copart is how Copart handles catastrophic events, so-called CAT events, like hurricanes where suddenly hundreds or even thousands of cars get totaled within a matter of days. And at first glance, you might think, okay, well, this should be great business for salvage companies. But in reality, it's incredibly challenging because everything has to happen at once. The towing, the storage, you even have to pay overtime for so many employees. They're just getting expensive and logistically complex for a company like Copart or IAA to handle that. And because of that, IAA has often pulled back in those situations, refusing to get involved when the economics looked too risky. And Copart took the opposite approach. They actually said, we are going to create an initiative, which they call 20-20-20, which was essentially a commitment to always be ready when large-scale catastrophes hit. So insurers could really count on them as a reliable partner. And it's probably not a coincidence that since that program was put in place, which was somewhere around 2016, Copart has significantly outperformed IAA and gained significant market share from them.
I have to ask whether you think that trend will continue, where you have Copart continuing to gain market share, just due to the dynamics you mentioned before, where I'm kind of thinking of Porter's five forces, where you have the insurance companies getting nervous, like, okay, we don't want Copart to wield too much power over this market. And I mean, I guess there's a game theory perspective of it because insurers are not acting as a collective single entity, but they're all acting in their own best interest. But at some point you would think there would be kind of a consensus of, hey, maybe we need to step in to balance volumes out again. Otherwise, Copart is going to have way too much leverage over us.
I think that's pretty on point. I believe it's more likely we will see a reversal of this trend instead of a continuation, and most likely not back to the levels of 2016, which would suggest that Copart is losing significant market share. But IAA has made significant improvements because it was acquired by RB Global, and since then they really changed up the company quite a bit. Not necessarily the culture, but they have, for example, significantly increased land capacity since the takeover. And just 4 years ago, Copart had about 70% more land capacity than IAA, and today it's closer to 25%. So it's obviously easier to scale if you lease or rent instead of buying the yards, but in the short term, I would say this makes IAA a stronger competitor regardless. And competition outside the US looks a little different, and that's probably where a lot of the bullish sentiment for Copart is sitting in the future because the business model is less proven over there. So Copart doesn't have a big counterpart as they have in the US, so they can really take a lot of the market share early on.
So for the audience, I mean, this is probably, I imagine it gets hard to track the industry dynamics and the composition of a business when we're just kind of talking out loud. So maybe just to take a step back, I would say Copart's moat, as I understand it, really rests on three main pillars. And the first is on the physical side. So that's the land in the salvage yard network, which in today's regulatory environment, it was a lot easier to build these decades ago. And now a lot of them are in very desirable locations where otherwise they would really not be approved if, cities and municipalities had their say about where junkyards could be put, because now you have maybe suburban neighborhoods around them. So it'd be very difficult for competitors who come in and replicate the value and the proximity of the land that Copart has just because of the way these areas have developed. That's the first pillar. The second is the technology platform. Copart had this first mover advantage in building out a global buyer base years before any of its competitors really understood how important that would become, it seems like. And that early lead still matters today, obviously. I mean, it's probably not hard to technically replicate what they do from a software standpoint, but that's true with a lot of companies. And really the advantage is the first mover advantage and the scale that comes with having this two-sided network where it becomes very difficult to compete with that. And what does it mean when I say two-sided network? Well, two-sided network it's a vibrant marketplace for both the sellers. It means it is the best place for somebody to come and sell something, and also the best place for somebody to come and buy something. And you get more of these mutually beneficial transactions. And there's not this asymmetry and you have a lot of people wanting to buy something. There's not a lot of supply, or vice versa. And it's that scale of the two-sided network that allows Copart to really consistently deliver the best prices because it has the most liquidity, which makes it the most profitable way for insurance companies to dispose of their cars. And I think we can really think of this as like the third moat.
And the expansion of the network of facilities creates additional economies of scale, right? The more facilities you operate, the lower your operating expenses are just by reducing the distance for towing, for example, or by just being closer to the action in case of these CAT events. And overall, it's just a pretty compelling value proposition. Just last week, we talked about FICO, and it's an incredible, strong company and with an incredible, strong market position. And I don't know if I would go as far as saying Copart's moat is that strong, but honestly, I struggle to see how a new entrant could realistically break into this business at scale, especially because there are so few companies that have been run with the same long-term mindset throughout multiple generations of CEOs. There has not only been Willis Johnson, but also the two CEOs following, which basically follow the exact same culture and just keep Copart going for the way that Willis Johnson would have wanted it. And even in international markets, we still have the risk of a local competitor copying the strategy. And then Copart is the first mover, and it seems to be the company scaling the fastest. And that gives me a lot of confidence that Copart's market power will continue both in the US long term, but especially also internationally.
So whenever we're thinking about adding a company to our portfolio, and obviously we're considering Copart here, the biggest consideration after we've started to wrap our head around what works for the business is then to think about, okay, well, what are the risks to it? What could make this business no longer work? And obviously, if it's working today, the risks of the past have not manifested, but that's not true indefinitely. And to me, I have two potential risks that come to mind. And obviously, I'd be curious to hear if you have anything else in kind of your reflections on these risks that I see. So the first is ride hailing. And, we really like Uber. The more people rely on services like Uber, the fewer cars are actually owned and driven, or at least it becomes less of a necessity to have to own a car, especially if you live in a city where there's already alternative transportation options, and then you layer in ride hailing. And so, fewer cars on the road could mean fewer accidents, which in turn means fewer vehicles ultimately ending up in Copart's yards. And then the second one, which I think is really related to that first point, is autonomous vehicles like Waymo. And I've talked about multiple times how blown away I was when I went to Austin and I saw these Waymos just driving completely by themselves without a human in the car all around the city. And honestly, they looked more competent than most of the human drivers on the road. So they're not perfect yet, but I mean, it's pretty clear the technology is moving in one direction. And at some point, they will probably have lower rates of accidents than human drivers in many places. And so if those accident rates do drop sharply, that would be a great thing for society. But as shareholders in Copart, that would mean much lower volumes for Copart to process, and it would actually be bad for the business. To some extent, they rely on a certain amount of a lack of safety in driving.
We've spent so much time thinking about Uber and just by extension, mobility and also AVs in general, that it's not surprising that you already nailed what I would call the two biggest risks for Copart. And just for the audience, after our episode on Uber, we kind of fell in love with the pitch and the company itself. And we've talked about it quite a bit in our community. And just recently, Shawn and I actually hosted a call where we went through the bull and the bear case again. And Uber has definitely been just top of mind for us. So before we dive deeper into those specific risks, though, I would say we should quickly zoom out a bit and talk about how risks in general look for Copart. And at its core, Copart's business is cyclical and it's tied to forces that are, I would say, completely outside of its control. The single biggest driver of supply into Copart's yards is what's called total loss frequency. Basically, the percentage of accidents where insurers decide a car isn't worth repairing. And not only does Copart have no control over the number of accidents that occur, but it's also dependent on used car prices. When they are high, insurers are more likely to authorize repairs rather than just write off the vehicle, which means cars flow into Copart's system. If they stop doing that, that would be a problem. Another important factor is weather. Natural disasters like hurricanes, floods, or even just hailstorms can suddenly push huge volumes into Copart's yards, and with thousands of vehicles declared total losses almost overnight. And in those moments, insurers depend on Copart's footprint to store and auction those cars quickly. And of course, those same events also pose major operational challenges, and we talked about them before: flooded storage yards, stretched towing networks, and sudden capacity bottlenecks caused by just huge upfront costs that Copart has to face. But still, Copart has proven resilient in the past, and just by its exposure to extreme weather, I think we will only see more of those weather and just climate catastrophes, and those changes drive more frequent and more severe catastrophic events, and in turn also more total costs, which should be a tailwind going forward.
I think that's a really interesting point because it would be kind of easy just to think of this thesis as really being primarily about car crashes. But no, I mean, as you said, the weather is, there's many different ways that vehicles can be damaged, and weather is a part of that. And with there being really this increasing pattern of extreme weather globally that's expected to continue to get more extreme in the coming years, and we've seen that with, insurance premiums for properties near the water, stuff like that. I mean, there's a lot of business impact of these weather events. And obviously with Copart, they are standing to potentially benefit from that, but at a minimum, be impacted. And so I think more important than just helping out insurers, what Copart is really doing is they're helping cities and states restore streets and roads and these areas that have been maybe flooded, and numbers of cars have been damaged. And they're kind of a partner with these municipalities and getting things cleaned up after a bad storm.
I think that's a huge part of why Copart will become more relevant for cities and states and just helping with such events. I mean, after Hurricane Ian in 2022, for instance, the company mobilized emergency leases. They brought in trucks and they stored and remarketed tens of thousands of vehicles. I think the number was 70,000. A response which management has actually highlighted as proof of its resilience. And the science and the insurance data, as you basically already said, they both show a clear trend toward more frequent and more severe weather events. And that basically means more catastrophic total losses. And that both adds volatility to Copart's volumes, but over time, it just reinforces their role as a critical partner for insurers, lenders, and then again also policyholders. And while I hope we see as few of those events as possible, of course, it's not unlikely this will become a more significant driver of volume in the future and potentially even containing the impact of AVs, at least to some extent. And speaking of AVs and also the Uber risk that you mentioned, this is really where we need to circle back to the idea of terminal value. We did that in some other pitches, and I think it's pretty important here. And to be clear, I don't think AVs is something that we're going to hit anytime soon. It's going to take many, many years before autonomous vehicles make up a meaningful share of the new car sales, and even longer before they replace the existing fleet. I mean, on average, cars stay on the road for about 15 years before they are swapped out. So even if we reach the point where AVs are the majority of newly sold cars, you would still be looking at another, let's say, 15 years before they dominate the fleet. And that said, even during the transition, the impact would already show up in falling salvage values and lower volumes. At least that's what we have to imagine now, looking at the amount of accidents that Waymos, for example, have, which is not a lot. So yes, I would say AVs are still a long time out, but they're definitely the most important thing to keep in mind when thinking about Copart's terminal value. As for Uber, I actually think that's a risk that might be a bit overblown or overstated. And we're both bullish on Uber as a business, but it's worth mentioning or remembering that we've seen massive improvements in public transport and bus and train system and taxi availability, and now with ride hailing as well. And yet, despite all of that, miles traveled in cars in the US have actually quadrupled since the 1960s. So from an environmental perspective, it will probably be better if the trend finally slowed down. But if we're being honest, that feels like more wishful thinking than something we can actually realistically expect.
I think there's another angle here that's worth considering too, and that is that Copart sells a large share of its vehicles overseas, often into countries with maybe not the same level of infrastructure or tech adoption as the US or Europe, which means you could argue that those volumes are actually more environmentally friendly than producing brand new cars to have the used cars sent there. And so realistically, that's probably also where Copart would continue to move its inventories once autonomous vehicles become more common in US and on European roads, with the point being, just because we see lots of adoptions of autonomous vehicles in 5 or 6 years, let's say, in LA, San Francisco, Austin, and New York, it could be many, many years, if not decades, before that sort of adoption is matched in many other parts of the world, which doesn't mean that Copart's business will last forever, but the ice cube may not be shrinking as quickly as some people would think. And you mentioned earlier that total loss frequency is really the main driver of Copart's volumes. And, with cars becoming more complex and more expensive to repair, especially as they get strapped up with all this autonomous vehicle technology, that total loss rate could actually rise significantly compared to today, even with fewer crashes, meaning the threshold for a car being totaled could actually be a lot lower in terms of the amount of physical damage to the vehicle. Because, if those really expensive sensors get thrown off, I would imagine that is costly to replace. And then the calculus of whether a car is totaled begins to shift very dramatically.
That's really a main point if you think about the thesis for investing into Copart, right? You already see it in the numbers. And if you just look at a Waymo car as an example, I mean, the cost is somewhere between $150,000 and $200,000, and it's packed with sensors, right? A dozen cameras, 6 radar units, and another 4 LiDAR sensors. So no matter where an accident hits, you're almost guaranteed to damage one of those. And the repair for that, I mean, that bill would probably be in the tens of thousands immediately. So sure, Tesla is showing you that you might not need that much hardware to make an autonomous car work, but I think you get the point. The technology itself is expensive and it's fragile. And another thing to keep in mind is that despite all the safety improvements of the last 30 years, airbags, anti-lock braking systems, and lane assistance, you name it, the absolute number of accidents has actually only fallen by about 8%. I think intuitively, I would have said significantly more, but it doesn't seem to really move the needle. Autonomous driving is obviously a way bigger leap than any of those earlier features. But when I put all the pieces together, more total losses whenever an accident does happen, the fact that adoption would likely take 30 plus years to work through the fleet, and the reality that past safety features barely dented accident numbers, I don't see AVs yet as thesis breaking for Copart.
I think I agree with you. It's probably not thesis breaking at this point in time, but of course, the market never wants to see really any kind of uncertainty around a company's core business like this. And so there is going to be a punishment for this kind of lingering shadow that is sitting over the future of Copart's operations. And so I'm actually surprised to see that the company trades at such a premium multiple still, even after selling off, given how there are some of these big picture questions about the future of mobility and vehicle ownership. And as we just keep moving along here, to kind of summarize a little bit, we've already gone through how Copart generates its revenues. We haven't really touched on the cost side of things yet, or whether there are many particular metrics or areas that as investors or potential investors, you would say we should be paying close attention to when we're analyzing Copart.
So there are actually some interesting things when you look at Copart's cost structure. You might remember that I mentioned earlier that the costs of their yards are capitalized, meaning they don't show up on the income statement, but instead they sit on the balance sheet. And that has the effect of artificially boosting margins compared to other businesses, especially IAA. And it's a similar story with most of the upfront costs tied to just processing cars. So things like towing or just doing small repairs before you can actually sell that car, all those costs also get capitalized. And if you look at Copart's 10K, for example, you will see that they roll them into inventory as well under a title called vehicle pooling costs. Beside those little quirks, you just have a business that just doesn't stop compounding. A 15% revenue CAGR over the last 10 years and over 21% for earnings per share. And the good news is that growth hasn't really slowed down in recent years, although the business obviously got way bigger. When we look at the CAGR of just the last 5 years, revenue grew even slightly faster at 16%. And while EPS only grew in the high teens, a single large share repurchase could push the CAGR higher again here as well. So the returns on invested capital that Copart earns, they are just a dream for every investor, consistently in the mid to high 20s. In recent years, there has been a downward trend, and generally that's something we don't want to see. However, in Copart's case, that's just due to their investments in more yards, which is an investment that has always paid off tremendously in the years and the decades earlier. And in the graphic that you can see on YouTube and Spotify now on your screens, I layered the CapEx spend over the return on invested capital figure just to show the relationship between both. And when Copart buys new yards, CapEx goes up, obviously, and return on invested capital in the short term goes down. It just takes a while until yards are running on full capacity, but when that happens, operating profits will outpace invested capital, and that will increase return on invested capital again. And it's also part of why the margins should reaccelerate in the years ahead.
Well, just since we're talking about the CapEx side of the business, you did mention how the free cash flow margin is honestly more important than just looking at the operating or net income margins due to Copart capitalizing a lot of its expenses. So how does it generally look for free cash flow? So what is the conversion compared to net income?
Well, it's difficult to say that you have a normalized conversion because it's fluctuating a lot from year to year. When you look at the years where the conversion is lower, you mostly see an increase in receivables and, most importantly, higher vehicle pooling costs. So all the costs before Copart can actually auction out a car. So let's say you have a hurricane and thousands of cars are totaled at once. Well, then Copart has to pay a lot of money upfront for towing, overtime for workers, and possibly even renting additional space to store all the vehicles. And from a pure Wall Street perspective, it might even be smarter at times to just not take on all those vehicles, but that's something Copart wouldn't do. IAA did that in the past and it hurt them in terms of market share. And they also see themselves, and they, I mean Copart, as a helper in times of emergency. We discussed it. They want to clean up the streets, remove all those total cars from the city, and it's part of what they stand for and what they think is the mission of the company, basically.
Yeah, I can imagine that also pays dividends when you think about the relationship with insurers. They always know that in times of crisis, Copart won't back out and they'll actually be there to help get the situation under control. And what I really like to see is that Copart's long-term thinking that they have and just the trust and the overall culture that has survived across generations. Willis Johnson founded the company and he is still involved as chairman, but Copart has already seen 2 CEO changes since then. So you had Jay Adair take over from Willis in 2010 and lead the businesses as CEO for 12 years. And he had worked with Willis for decades by that time. So it's not surprising that he would make sure that the culture continues to persist. But even now with Jeff Liao as CEO, Copart continues with the exact same philosophy.
It might only be me, but I personally get Berkshire vibes just hearing that.
No, I think you're right. And we just love to see that kind of thing. It's just so special and it's so uncommon. To anyone who doesn't, believe us, I mean, seriously, it is incredibly uncommon in corporate America to find these kind of things. So when you see it and you have a company that's already doing so well and has such a great track record, that just makes the investment so much more interesting. And so, we've looked at many companies by now. And like I said, you just really start to appreciate the importance of the management team. I think it's something that kind of beginning investors don't know to pay attention to or don't know how to pay attention to it. But one of the key themes that I have seen as I've spent more and more time studying companies and learning from great investors is really this message that the management team matters a lot. And culture is one of the few things that you can, at least to some extent, really try to guarantee that the successor will do a good job of maintaining. And so with Copart, I don't think there's a ton of key man risk with this exceptional culture that's in place. You could probably say the same for Berkshire Hathaway with Greg Abel taking over for Buffett. It's not like the company's identity is going to dramatically change with Buffett gone. And so, of course, I mean, there are always things that Copart is maybe not doing that Wall Street and some other investors would like to see, but that is just how it is. And I think on the capital allocation front, that's maybe where people have been more critical.
Yeah, Copart is not doing anything because Wall Street wants to see it. In terms of capital allocation, Copart doesn't pay a dividend and it buys back stock, but it only does so when it thinks that Copart is really trading at a cheap valuation. I'm not talking about expecting 10% returns per year. We're really talking about a steep discount in the stock price, which might not be a good thing for us because they haven't bought back shares since 2020. And the last meaningful share repurchases actually only happened in 2016 and in 2019. In the graphic currently displayed on the screen, I've overlaid Copart's buybacks and the stock's PE, and you can see it perfectly here because the annualized PE is a bit higher than the points where the buybacks actually happened at the time, but I think the trend is visible. So Copart buys back stock at PEs in the high teens, on the 20s. Currently, the stock is trading at a PE of around 30, and in the last 2 years, it actually traded closer to a PE of 40. But the point being that Copart's buybacks seem to be a pretty good proxy for an under or overvaluation of the stock. And although the management also says that they consider buying more land to be more value accretive long term. And judged by Copart's ROIC, I have to agree. If Copart can achieve 25% returns on invested capital into new yards, that's the opportunity cost for doing buybacks instead. So the fact that we're not seeing buybacks, I think it doesn't mean that management thinks the stock won't have good returns. It just means that the returns at these prices don't look as attractive as just buying more land.
And that's exactly what you want to see. I mean, a business that has enough opportunities to deploy capital at high rates of return, that is ideal. And this has worked for Copart for decades. And I think there are no signs of that slowing down. And as you've told me before, management is still viewing buybacks as really the number one way to return capital to shareholders. So I assume that really they're just waiting for times when the stock is really seriously underpriced. And it seems like that is what they've done in the past. And the other thing we like to see is that insider ownership is very high too. Willis Johnson still owns $2.8 billion worth of shares. So that's more than 5% of the company. And Jason Adair owns another 2.5% of Copart. And then combined, the other insider ownership from the executive team stands at over 8%. So that's very substantial.
What might even be a better example of just how the culture is important to Copart and how aligned the management is with the shareholders is the executive pay structure. Executive chairman and former CEO Jason Adair is famously just paid $1. He gets no cash bonus and he has declined any new equity since 2020. Willis Johnson is compensated like every other outside director too, with a modest cash retainer of $57,500 and a standard annual stock option grant worth about $250,000 for the founder of a company that's now worth well over $40 billion. I'd say that's not a lot. And these stock options, they're also front-loaded, which means that they run over multiple years and they cannot be renegotiated in between, and you only get them when you actually stay with the company long enough. Johnson's option term, for example, is 7 years, and all of the options are also tied to price hurdles. So if the stock doesn't perform, they can also not be exercised. In Copart's case, the stock must trade at 125% or more of the strike price for 20 consecutive trading days. Only then the option can be exercised. And with that, you just eliminate the risk of having a huge skyrocket price for, let's say, 5 days up on good earnings because you just polish them in a certain way and then you can access your options. That's not possible under this plan. And the current CEO, Jeffrey Law, has also a base salary of $900,000, which is significantly higher, but let's be honest, it's still very low for a company, as I said, worth $40 to $50 billion. And his options otherwise have the same structure as Johnson and Adair's. And I don't know, it's just a structure that personally I like to see as a shareholder. However, on a more negative note, insider trading tells a similar story to the buybacks. We haven't seen any insider buys in a while. And compared to the insider stakes a couple of years ago, we've seen actually 3 to 4% decreases overall, which is quite significant. And both Willis Johnson and also Jason Adair sold shares. And to be fair, insiders can sell for many reasons. And I think in Jason Adair's case, those were mostly scheduled sales. So I wouldn't overstate this, but the fact that they're not buying does show that Copart is probably not a huge bargain right now.
I really like that way that they hedge against, there's so many famous corporate case studies of the CEO of a company having their bonus set to, the stock being at a certain price at a moment in time. And, without getting deep into accounting, there are a lot of things that heads of companies can do to cheat earnings and kind of manipulate things to look better in the short term. And you can't do that forever. But if you want to beat one specific earnings target to make the stock pop, so you unlock a balance, that is actually very possible to do. And so the way they hedge against that, I think is very interesting in making sure that no, management actually has to sustain appreciation in the underlying value of the stock over time for those bonuses to be unlocked. And so it really does seem similar to the Buffett playbook we've seen at Berkshire, at least in terms of the buybacks that they do. And a couple of weeks ago, we talked about Berkshire a lot because we pitched them for the portfolio. And with over $4.8 billion in cash, that is some serious ammunition for buybacks when management thinks the time is right. So I kind of get excited about that, just thinking, okay, hey, at some point, Mr. Market is going to give a more attractive price on this stock, and they've got a lot of pent up dollars that can go toward creating value for shareholders by purchasing stock at relatively discounted prices, and they're probably the best judges of what the company's actual intrinsic value is. But maybe we'll see them do an acquisition instead of buybacks. But either way, it's easy to have a lot of faith in this management team and their ability to figure out the optimal places to allocate capital. And so I did want to just linger on that point on acquisitions, though, because you have mentioned that it's something they've used in the past to expand their businesses. So maybe you can talk more about that and really where we are at with that process and just generally the growth drivers and opportunities for growth in the future for Copart.
If there's one thing I'm really not concerned with when I think about investing in Copart, it's the capital allocation of the company. There's some companies, when I see they have $5 billion in cash sitting around, I'm kind of asking myself, what are they doing with it? Is this even cash that I should maybe even discount when I do a valuation? That's not the case with Copart at all. We already discussed the two big acquisitions of the 90s, which were North Texas Salvage Pool, which was the US's largest salvage seller, and NER Auction Group, which added roughly 20 additional salvage facilities and basically back then doubled Copart's processing volume overnight. And as Copart moved to international markets, it continued to use acquisitions to get a foot into these markets. In 2018, for example, Copart acquired a Finnish salvage company whose pronunciation I would undoubtedly butcher, which is why we will go with the acronym AVK. And it was a small, basically tiny acquisition. It was less than $10 million, but it's an example of just how Copart uses strategic acquisitions to find its way into those foreign markets. And beyond geographical expansion, Copart also diversifies into other verticals. It acquired National Powersport Auctions in 2017, which mostly focuses on motorbikes, and more or less recently, it bought a majority stake of 80% in Purple Wave, and that move extended Copart's auction model into construction, agriculture, and also fleet equipment.
That is really one way to hedge the risk of autonomous vehicles, is by moving away from cars a little bit and whether it's jet skis or John Deere tractors, looking at all types of vehicular equipment or sporting gear. And so, basically they're onboarding more verticals that may or may not be less prone to being replaced by self-driving cars, basically.
I'm just pretty confident we will see more such acquisitions over time. But again, it's not like I consider Copart's business model to be under immediate threat. In the recent earnings call, management said that the current cash position shouldn't be seen as piling up cash for possible M&A. If an opportunity comes, they will take it, but they are not waiting for one. Their strategy for acquisitions is to only buy companies where they would feel confident in buying the business also as a standalone company. And then they think about, okay, where are the synergies that might make sense for Copart? And if a company checks both of those boxes, then Copart will acquire it if they can at the right price. Otherwise, they will just focus on growing the business the same way they did before for decades by now, and maybe a little more focus on the international markets. Although the numbers make concentration on the US look more severe than it actually is. All the sales that originate from the US, for example, they are counted as US revenue, although 40% of those vehicle sales actually come from the US, but they go to international customers. So the vehicle sales business overall is more 50-50 between international and then between US markets, while the majority of Copart's service business still comes from the US. But if everything goes right in international markets, I would say we could see a shift where Copart then changes to the service model in international markets too. And to some extent, we already do see that. And international growth is needed. If we assume that Copart's US market share is about 50%, well, then the market could be estimated at around $10 billion annually, which is not that much. And while Copart will continue to take market share here and there, we know that this will not become a monopoly as we discussed before. So I think it's fair to say that the US market is mature and most of the growth still sits in international markets. And Copart is already operating in places like the UK, Germany, Spain, Brazil, Ireland, and Finland, as we discussed. And while the fact that they first have to prove to international insurers that their model works means that they are pioneers in those markets, you could also argue that it comes with certain risks and difficulties that they're just not facing anymore in the US. The first one that comes to my mind is that they do not have the same footprint of yards in those countries. Although I must say, I was surprised by the number of locations they already do own. In the UK, for example, they own 20 yards. In Germany, it's 9, 10 in Spain. I think it's over 30 yards in Finland, mostly due to the acquisition they made. And according to Copart itself, it's the biggest player in the UK, Brazil, and the Gulf states. So they're really, by now, probably more of an international company than just a US-American junkyard.
And so what about the non-insurance side of the business here? I mean, I know insurance companies will always be at the core of Copart's business, but it does seem like the company has steadily been broadening its base. You got rental fleets, dealer trade-ins, finance companies, banks, and even individuals that are increasingly feeding vehicles into Copart's ecosystem. And in the US wholesale auto market, something like 17 million vehicles change hands every year, which is several multiples of the insurance salvage market. So even if Copart only captures a sliver of that volume, the opportunity seems like it dwarfs their current addressable market.
That's a huge opportunity, which is why Copart has been steadily expanding beyond its core insurance salvage business with its business arm, which they call Blue Car. And Blue Car focuses on whole cars from banks and finance companies, dealers, rental fleets, and even individuals can actually sell their car through its Cash for Cars brand that Copart owns. And by pulling in used cars, Blue Car feeds them into the same auction system that insurance companies or cars also run through. And that just means they immediately tap into Copart's huge global buyer base. In 2021, for example, more than 20% of vehicles sold came from non-insurance companies. And since then, that segment has grown faster than the core segment, which means that in fiscal year 2025, Blue Car has not only grown 15%, which is faster than the core segment, Copart also says that the share in general, without actually giving us the details on the numbers, should have increased significantly since 2021.
Well, I think it's that time where we go and maybe take a look at trying to think through the valuation here. And I feel like it would be hard to listen to this conversation and not think that Copart is a phenomenal business, or at least a very good one. And that if we can buy it at the right price, of course, it would be a great addition to our intrinsic value portfolio that we're building every week on this show over time. And so I would say a common theme in our portfolio holdings, though, is that the market is not seeing the business necessarily through the same lens that we do. Meaning we have a different opinion, maybe a contrarian opinion, where we feel like we're able to buy a company at a discount to its intrinsic value. But in this case, the market is pretty clearly in agreement with us. It's not a secret that Copart is a great business. And the question is, what is a fair price for such a great business, and whether we're even beyond that threshold. So how does that look? Is Copart fairly priced? Is it at a level where it is still attractive to us?
Well, it's funny because we started our pitch saying this business is so boring and the entire industry is. And this is often used for, as an excuse to say you can find businesses here that are cheap because the market overlooks them. But if we're being honest, Copart hasn't been overlooked in decades now. You see few companies where the growth chart across all metrics you look at is just as beautiful and as predictable as with Copart. Revenue, profits, EPS, cash flows, everything is growing year in and year out. And Wall Street loves predictability. So it's not a surprise that you have to pay for that. Copart is not the type of business that will suddenly start growing the top line by, let's say, 20%. Low and stable double-digit returns are what I would personally expect from Copart going forward. And Willis Johnson actually once said, I learned an important lesson, and that was not to grow too fast. You will have to grow slow and steady. Wall Street makes you pay for it. They always compare you to last time. And if I just look at their stock chart and also at the financials, he's completely right. And it seemed like he lived by that lesson. What that means for us, though, is that we don't really have to walk through a bull, a bear, and then a base case like we usually do. I don't see a world in which Copart in the next 5 years will only grow by 5% per year. And as I said, I also don't see a world where they would grow by 20%. So in my model, I estimated an 11% growth rate for the service revenue and 1% for the vehicle revenue. And you might ask, why only 1% for vehicles when in the last 5 years, this has grown by an average of about 30%? Well, because 2021 and 2022, as we discussed earlier, they were total outliers in which the segment basically grew 60% per year. And because of the higher used car prices, Copart focused on this segment intentionally and increased volume in that space. But since then, the segment has been pretty much flat, and half of its business comes from the international markets, where, as we discussed, the long-term goal is to switch from the vehicle sales to the service model. So Copart's margins have seen similar improvements to the rest of the financial metrics, with a slight decrease over the last 3 years, similar to what we've seen with the returns on invested capital, primarily due to CapEx investment. So while the land doesn't hit the PL, the buildings, the equipment, and basically all of that stuff shows up on the PL in the form of depreciation at some point, and that point is pretty much there now. So the recent quarter, Copart's margins have already been improved significantly with the switch from the purchase to the service model in international markets, and especially Germany, caused international gross margins to rise by 1,000 basis points from 25% to 35%. And I'm pretty confident we will see further margin improvement in the years ahead. So I personally see Copart hitting, let's say, 41% operating margins in 2029. And while I don't forecast more than 5 years, we basically never do that because it's just a time frame that would be too hard to estimate for us. I do suspect that operating leverage will increase beyond 2029 and probably increase margins even further.
So where does it all leave us? Like at the time of recording, the stock is currently priced at almost $50 a share, and there's a forward PE of 30 implied there. So do you expect it to continue to trade at this kind of premium in your model? I know that if we look at Copart's valuation history, it is trading at a slight discount to the median PE of 33 that it's really traded at since 2016.
Well, Copart is a premium stock, but we have recently seen with Trade Desk, for example, what can happen to companies that traded at premium multiples when they can't perform in line with the market's expectations. So Copart is a much more stable business, but even here, we've seen a contraction in the multiple from 45 from last year to just 30 now. So this is a long way of saying that the implied exit multiple in my model is 126. At a discount rate of 8%, this leaves us the fair value in the low 40s. And if you want to put a margin of safety on that, I used a 10% discount on my end. The fair value estimate would be somewhere in the high 30s. So right now, Copart is not yet what I would call a no-brainer. I know that many believe you have to pay up for good companies. And if you are an owner of Copart stock and potentially even sitting on larger gains, I can completely understand why you would hold on, and returns will probably be just fine. But we know how fast stocks can sell off. So for us, Shawn, I think I would suggest waiting for such a sell-off with Copart. In the high 30s, I would make this probably a 5% position or larger immediately. Right now, you could make a case for a small position and say 2% and then double down if it goes down further. But it could be an opportunity cost for a while.
In just the last 3 years, we've seen the stock swing from something like less than $27 per share to as high as $63.43. I think that was the exact peak that I can see on the chart right now. So, I mean, there's definitely some volatility to be taken advantage of here, even for a company as high quality as this. And I think we're at a threshold now where Copart shares are probably just starting to get interesting. And maybe depending on your level of conviction in the business, you may or may not begin to find them compelling at these levels. And like you said, though, Daniel, for us to initiate a new position from scratch, we'd really need to feel confident that this stock can not only outperform the market, but also our other portfolio of bets that we could be reallocating cash towards. And when you have such a rich multiple here, all it really takes is one disappointing quarter for the stock to fall 20%. And in the long term, even that doesn't really matter all that much to the underlying business if it keeps growing steadily. But still, it's hard to get too excited about the stock at current prices when it could sell off pretty meaningfully and still be at a considerable premium to the S&P 500, which, you know, is a collection of some pretty good companies too. And so that is really not at all what we would call a margin of safety. And we've seen the stock fall between 15 and 20% year to date, which is nice, but I think we need to get another move of that magnitude to the downside before I would start to feel really good about starting a position in the company. And otherwise, it's one of those where I'd say, hey, it's probably a good bet. I don't judge anybody for buying it, but at the same time, I don't mind being patient, and it's not so obviously a good bet that I feel like I have to roll the dice.
I totally agree. I think it feels somewhat like a cop-out when we say, okay, we need another 10 to 20% drop. But Copart has done something in the last 2 quarters that it has never done before. And that's disappointing. So as you said, Shawn, I think there's a good chance we will be able to pick it up at a lower price point at some point. And for all the listeners, we might say this a lot, but I would personally argue that we are as close to establishing a position as with few other companies that we looked at. And I would honestly be surprised if Copart does not end up in our portfolio at some point. But as you said, we do pay a lot of attention to price. So for now, it's on the watch list. All right. With that, how about we end today's episode and you give us the hints for the next one?
Yeah. So next week, I'll be making my pitch for a company to add to the intrinsic value portfolio. And you can tell me whether it's overvalued or not and whether you want to add it. But it is going to be another high moat compounder next week. And it's actually a company that's very deeply ingrained in the financial market, I would say, but it is not a payments business. As some listeners will know, I have a bit of a love-hate relationship with payments companies. So their business model is really more akin to collecting passive royalties for the products slash services that they provide. And really, they're mainly providing this service to asset managers who rely on what they do to run their mutual funds and ETFs. And so I don't know. As always, I kind of feel like that's giving a lot away, but it's just a last hint. They're particularly well known for their role in international stock markets. So that's all I'll give away for now, but it'll be another pretty interesting discussion and another just really incredible business where we try to figure out if the price today is fair.
That sounds good to me. And I still think I have to wait for the day when Shawn actually brings a payment company to us and pitches one. All right, I will leave you all with a quote from, of course, Willis Johnson. He said, "Be your customer's most valuable partner." I think it's fair to say that Copart has been that for decades, and I would be more than surprised if that changes over the next decades. And if they continue to be it, it's probably going to be a good investment. And with that, have a good one. See you all next Sunday.
The beauty of Uber's model is that the vehicles are not on their balance sheet, and drivers can opt to make themselves available in response to demand in real time. Thus, Uber drivers can be incredibly flexible about responding to ride requests and a lack thereof. Another way to maybe say that is that supply on Uber's platform naturally adjusts to demand. And for, say, Waymo to try and allocate XYZ number of cars to a city that will displace Uber, well, the reality is that they're either going to under allocate vehicles or over allocate them at any given moment in time. There's just no way to perfectly match demand with a fixed supply of vehicles driving around, which is why it's better to deploy a more limited fleet and just partner with Uber, tapping into their network for bookings. And then the vehicles can be used for other purposes or as just an occasional alternative to a regular Uber.